Good morning. My name is Spencer Levy. I'm an Executive Managing Director at CBRE Capital Markets, and I'm thrilled to be joined today by Joe Dykstra, Executive Vice President at Westwood Financial. Westwood Financial is a large owner of retail properties based in Los Angeles, California, and Joe is here to talk to us a little bit about some of the things that Westwood is doing, a little bit about what trends are going on in the industry. So first, Joe, good morning. Thanks for joining us.
Thank you.
And Joe, tell us a little bit about what Westwood Financial is trying to buy. What are you guys trying to do today?
Well, Westwood Financial is a private company, and we invest our own capital into necessity-based retail. Mm-hmm. We have a national platform we can buy in most gateway, primary, and even secondary cities. And we think that the last 4 years have been fantastic. The debt is cheaper than ever. The cap rates are still good enough for the kind of properties we're buying. And so we're excited.
Well, let's dig into that a little bit more. Joe, you have several different ways to buy in your company. You have a couple of different funds, one that focuses on the larger deals, the one that focuses on the smaller deals. Tell us a little bit about your capital sources at Westwood Financial and how you break up your different types of acquisitions.
Well, we trade out of two buckets. We have a value-added platform, and we have a core platform. And on the core platform, we're investing on behalf of about 100 partnerships that we've controlled for almost 40 years. And we sell assets as we've maximized cash flow, and as we want to rebalance our portfolio geographically. And we go out and we look for basically bigger and better properties. So on the core side, cap rates in 09 and 10 were very attractive. Today they're 7 and lower. In some cases even lower than 6. So it's harder and harder to buy in the bigger cities. But we're going to secondary cities like the Omahas and the Kansas cities and the Milwaukees and the Raleigh Durhams to find our property.
Well, let's dig into that a little bit. In one of our prior interviews, one of the companies that we spoke to has a concentration in the Midwest, but what you're suggesting is that you're going into these secondary markets. Now, the interesting thing about secondary markets is I think many of the investors that we're going to meet with here are all going to say we want to go to secondary markets because the cap rates are a little bit higher and the fundamentals are still good, but you're actually doing it, which is great. Now, talk to us for a moment about how you think about buying in a secondary market versus buying in a primary market. What are some of the pros and cons?
Well, I think in a secondary market, the location is even more important than if you're in a primary market. You have to make sure you understand where Main and Main really is. We buy real estate. We don't buy credit. We buy property that we feel like if it has to reinvent itself, if we have to replace an anchor tenant, or if we have to replace any tenant, that the location will drive the business. We don't make credit decisions. So in the secondary markets, you really have to spend a lot of time in the trade area to make sure you really understand what you're buying.
The other thing I've noticed about your portfolio, I took a look at the assets you've bought in the last year. Most of them were smaller. I would say that they were probably on average less than $10 million. Would you say that that's an area where you have a competitive advantage versus, say, buying the larger deals, call it north of $20, $30 million?
I think there is an advantage. We do try and navigate around the REITs and some of the big pension funds. They typically want to buy 20s and 30s and 40s, and we're very happy buying 10s. But the fact is, the reason we don't like big boxes. We want to buy the necessity-based retail piece of the property. In a portfolio of ours, we have 120 properties, and we probably only have 10 boxes larger than 15,000 feet, other than grocery stores. All our partnerships are siloed, so if we have a big box problem, we have a big problem. So we like to buy the properties that have the small shop space. We think we can lease them, and we think we have a track record of getting that done.
Okay, well, let's talk about that for just a second. You're staying away from the big boxes, but you do go into the grocery-anchored space. Right. In a lot of our prior discussions, there was some discussion of encroachment in the grocery space, that there's some risk there for smaller grocers and even internet encroachment. What's your opinion on the grocery-anchored space generally?
We think that the grocery-anchored space is where you want to be. You certainly have to be very careful. You have to select your grocery store carefully. We don't make credit decisions. We make real estate decisions. So we look at how well the grocery store is doing, even though it may not be a top-tier supermarket. If they're doing well enough to justify the location, we believe that at the end of the day, they could ultimately be merged into a bigger company. So but you have to be careful. The top tier grocery stores trade at very low cap rates. We can't buy that cap rate. We can't buy that yield. We need the buy lows. We need the Winn-Dixies. We love Kroger. We love Publix. We like all the obvious people, but we can't pay those cap rates.
Let's go back to something we mentioned a moment ago. We talked about secondary markets.
Right.
We talked about smaller deals, and now we have your two buckets of capital: your core bucket and your value add bucket. Now, I would say, generally speaking, a lot of people use that term value add. And what does it really mean? And what does it mean to you?
Well, for us, value add means to buy a property and within a reasonable period of time, lease space, add value, and sell and harvest profits. And we've done that probably 15 times since '09. And that pipeline is drying up. The banks and the servicers are going through their portfolios, and they've pruned it quite well. But we have successfully bought, leased, and sold properties and harvested some profits in the short term. But that business is going away.
Now, let's go one step further out into the spectrum. You have the core, you've got the value add, and then you've got the opportunistic on the far end. Would you have the same comment about that there's very little of that? I guess once you get into the opportunistic end, development starts rearing its head. Do you ever look at opportunistic investments, or that's really outside of the box of what you'd be willing to do?
It's really outside of our box. We like small properties because we think we can manage them and we can tolerate the risk. We think we understand what the balance sheet requires in order to own it long term. We know that we can finance it. We know we can fix the problems. When you get into the more opportunistic properties, we think those are projects that could go 3, 4, 5 years. And personally, we don't want to be selling into what could be a rising interest rate market.
Well, let's touch upon that for a moment here. A lot of the things that we've talked about in the last few interviews is the time horizon of when you're buying today an asset that has a long-term net lease. That's one thing. But when you're buying a value-add asset, you really have got to look in your crystal ball to some degree of what's happening 3 or 5 years from now. How do we, as an investor, look at 3 or 5 years from now, or is it really just very challenging to do?
Well, we operate our business with the mindset that interest rates are going up. We buy property, we finance it conservatively, because we believe that 2 years, 3 years from now, there will have to be a lot of pressure to see rising interest rates. So we borrow long term, we borrow 10 years, we borrow 15 where we can, but we like small shop space. Part of the reason is we know that we'll get rent increases out of our small shop space, and if I'm buying big boxes or even national or regional tenants that are locked into long-term leases, that when we have inflation, it'll be very hard to access the upside.
Got it. Let me ask you a question regarding underwriting. A lot of people, and I presume yourselves included, are very IRR driven when you look at your investment. Recently, we've seen some people looking more cash-on-cash related, which I would call cash-on-cash old school real estate investing 101. But really, we kind of moved away from that to IRR. But the difference between IRR and cash-on-cash is cash-on-cash allows you to go into some of these secondary markets because your exit is not quite as important if you're prepared to hold longer term. What do you do when you're buying today in a secondary market? Let's say you're buying at an 8 cap. How do you underwrite your exit cap rate? Are you putting a 50, 75 basis point premium on that, or what's your typical underwriting standard there?
Well, we're buying cash flow. We're not buying IRR.
Okay.
And where we can, we borrow for 15 years. 15 years is a long time. Even 10 years is a long time. So we're not focused on our exit. We're focused on buying the right property with the right amount of equity, with conservative debt, so we know that we can ride out any storm. And it's impossible to predict what kind of cap rate you can sell a property for in 10 years. So frankly, the disposition cap rate for us is meaningless.
Okay, that's good to hear. Now let's go back to the debt question for just a second. You're suggesting you're trying to finance at 15-year terms, maybe shorter than that if that's what you can get. But how much is that driving your ability to buy today? What the debt capital markets, given how cheap it is, how available it is for certain types of assets, how much is that driving your ability to buy certain types of assets that maybe you couldn't have bought but for the availability of cheaper debt?
It's all about the debt market. Anybody that would suggest otherwise is, we think, kidding themselves. If you look at what's happened to the CMBS market in the last 24 months, it's exploded. And it's allowed for people to buy secondary markets. Life companies generally don't like to go into the Macon, Georgias and the Augusta, Georgias, and even the Raleigh, Durhams. So the CMBS guys have really come forward and made loans on properties otherwise we don't think it would probably trade at any price.
And these loan to values are expanding. The cost is very cheap. And you're right, secondary markets are key for CMBS because a lot of other folks won't go there. Local banks may go there, but they're not going to get anywhere as near the cost of capital that a CMBS lender.
It's all about the CMBS market.
And right now they're expanding out there, and they're doing smaller deals too, correct? I mean, we've seen quotes for $5 million deals.
I think the CMBS guys are doing a great job, and there's a lot of options for almost everybody right now.
Great. But you said correctly that, look, there is risk of interest rates increasing in 3 or 5 years, and I think most people believe that's when it's probably going to happen. But if you lock in 15-year paper, you're going to be in pretty good shape longer term. So let me ask you one final question here, Joe. The future of retail. We've both been in this business for a while, and we've seen tremendous change over the last several years, and we're talking about the debt capital markets. What could we do as real estate investors today to best position ourselves as investors for the next 3, 5, 10 years, whatever comes our way?
Well, we're investors. We're not developers.
Yes.
So I would like to see less properties developed. Therefore, I would like developers, lenders, cities, tenants to be more disciplined. I would like for them to look inward and redevelop stores and sites as opposed to expand out into the suburbs. We've all seen what's happened in the last 4 years. Very little has been developed, and occupancies are increasing. Real rents are increasing, again, for the first time in a long, long time. But I think it's unrealistic to expect that will happen. But it would be very, very good if we have a lot more discipline for several more years while the markets continue to heal themselves.
Good. Well, certainly we have not seen new development yet in retail. I think that it's coming. I had meetings in the last couple of weeks with big institutional investors who do development in build-to-suits and industrial, and they're saying pricing there has gotten extraordinarily competitive. They have to start expanding out. So hopefully that discipline could last at least for a while, but it may not last forever. So on behalf of CBRE, we're thrilled to have had Joe Dykstra from Westwood Financial. Joe, terrific job.
Thanks
for coming, and I hope you have a wonderful conference. Thank you very much.
Thanks a lot.